These signs appear before every market crash, not after, not during, before. And the scary part is most people see them and still ignore them. If you skip this, you will see these signs again, but too late. Before you scroll, listen carefully. Every major market crash in history was visible in advance. Not obvious, not loud, but clear if you knew where to look. Most people don't lose money because of crashes. They lose money because they ignore the warning signs. And today, those warning signs are flashing again. Stay with me because in the next few minutes, I will show you exactly what smart money is watching right now. If you want clarity instead of panic, don't. This isn't fear mongering, this is a pattern recognition, and history has a habit of repeating itself. The market is rising, but confidence is falling. Here is the first red flag. Markets are near high, but people don't feel rich. Consumers are spending, but only one essentials. Businesses are reporting profits, but quietly freezing hearing. This disconnect is dangerous because markets don't crash when things are bad. They crash when reality catches up to expectations. Ask yourself, does this market feel strong or fragile? If this feels familiar, it's because this is exactly what happened before past crashes. Warning sign. Central banks are trapped. This is one of the most overlooked signals. Central banks today are stuck between two bad choices. Raise interest rates, economy slows. Cut rates, inflation comes back. Either move hurts the market, and when policymakers lose control of the narrative, market loses confidence. Crashes don't begin with bad news, they begin with confusion. If the people steering the ship look unsure, prepare yourself. Every crash starts with investors realize the safety net might not be there. Warning sign 3. Too much money chasing too few real opportunities. Let's be honest. A lot of money today isn't investing, it's searching for exits. You've seen it in overvalued stocks, hype driven assets, sudden, sudden rotations between sectors when capital move fast. It's not confidence, it's nervousness. Smart money doesn't scream, it moves quietly. Watch where money flows, not what headline says. Warning 4. Debt is growing faster than income. This one is critical. Households, corporations, even governments are carrying record level of debt. But income growth is slowing. Debt works when growth is strong. When growth slows, debt becomes a weapon. And market hate one thing more than bad news. Unsustainable debt. If debt needs perfect condition to survive, a storm is coming. Every financial crisis is at its core a debt problem. Warning sign 5. Volatility is being ignored. Here is a silent warning. Volatility is rising, but investors are acting calm. That's dangerous. Complacency before a storm is what makes the storm deadly. When markets believe nothing bad can happen, that's when something always does. Low fear in a risky environment is not a confidence, it's blindness. Warning sign 6. Corporate profit look good, but margin are shrinking. Yes, earning my looking strong, but look deeper. Costs are rising faster than revenue, margins are shrinking. Companies can hide this only for so long. Once profit pressure shows up, layoffs follow. Then spending slows, then market react. This is how crack spreads. Strong numbers don't matter if the foundation is weakening. Crashes don't happen in one day, they build silence. Warning sign 7. Retail investors are overconfident. This is uncomfortable but true. When inexperienced investors feel invisible, risk is at its highest. You hear phrases like, this time is a different. Market always recover fast. You can't lose long term. History punishes overconfidence. Market reward patience, not bravado. If everyone thinks risk is gone, risk is everywhere. Warning sign 8. Liquidity is drying up. Liquidity is oxygen for markets. When it's easy to borrow, market flow. When liquidity tightness, weak assets collapse first. Then strong ones follow. Right now, liquidity is quietly shrinking, and markets don't fall because of fear, they fall because buyers disappear. No buyers means no floor. Markets don't need panic to crash, they just need silence. What this all means for you? Let me be clear. This doesn't mean a crash is guaranteed tomorrow. It means risk is rising. Smart investors don't predict crashes. They prepare for them. Preparation is boring. Panic is expensive. The goal isn't fear, the goal is positioning. Survival beats prediction. What smart money does during these signs? They reduce unnecessary risk, hold more cash, focus on equality, avoid hype, think in scenario, not certainty. They don't chase returns, they protect capitals because money made in good times is often lost in bad ones. The first rule of wealth is staying in the game. Remember this, every cash feels obvious in hindsight, almost invisible in real time. The signs are never perfect, but they are never absent either. Right now, the market isn't screaming, it's whispering. And those who listen early don't panic later. If this helped you think clearly, not emotionally, like this video. Subscribe for real market clarity, not noise. Share this with someone who thinks crashes come without warning. Stay sharp, stay prepared, and remember the market rewards those who see early and act calmly.